Welcome to today's webinar on IAS 20 Government Grants. My name is Kanyisile Kwabe. I am an IFRS consultant at W.consulting, and I will be taking you through the webinar today. IAS 20 is a standard which governs the accounting for all government grants, as well as the disclosure of government assistance. There are, however, a few items which are not included in the scope of IAS 20. These items are things such as government assistance, which may occur in the form of tax benefits, such as income tax holidays, investment tax credits, accelerated depreciation allowances, as well as reduced income tax rates, just to name a few. Government participation in the ownership of an entity is also excluded. These would typically be transactions with owners of an entity, and as we are aware, these would be measured within equity or recognized within the equity of an entity. Government grants covered another standard, namely IAS 41 Agriculture, are also excluded from the scope of IAS 20. Just to give a brief overview of the government grants which are included in IAS 41, as well as the requirements of that standard. Biological assets, which are measured at fair value, less cost to sell, as well as those government grants received to ensure that the entity does not engage in specified agricultural activity are within the scope of IAS 41 and not of IAS 20. For these assets, if the government grant is unconditional, it is measured or recognized in profit or loss when it is receivable. Where the government grant is conditional, however, the grant will be recognized in profit or loss when the conditions are met. For those assets which are in IAS 41 but are measured in accordance with the cost less accumulated depreciation and accumulated amortization method, these will remain within the scope of IAS 20. Government grants are defined as assistance by government through the transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of an entity. This, however, excludes government assistance, which cannot reasonably have a value placed on it, as well as transactions which cannot be distinguished from the normal trading transactions of the entity. A question then arises as to what happens when government implements a program or programs to support development in certain industries or areas or regions. An example of these would be government choosing to provide support to operate in a certain industry. So the government may adopt a policy where they try to promote buying local and promote manufacturing within the jurisdiction. They may then offer government support for entities which operate in the manufacturing industry. Another example could be grants provided to entities to encourage them to either start or continue running an operation in certain underdeveloped areas. It may well be that the government has identified a need or an excess demand in a specific underdeveloped area and is trying to create an incentive for entities to move their operations in that area. Question is, do these now meet the definition of a government grant? Should they be recognized in IAS 20 or should they be recognized in terms of another standard? The ISB responded to these questions through the issuance of SIC 10. This interpretation states that the assistance, which was just mentioned, meets the definition of a government grant, even though the only requirement is to operate in certain industries or areas. As a result, this form of government assistance should be recognized in accordance with IAS 20. Government grants do not necessarily only take the form of cash. These may come in various forms. So the government may transfer cash directly to an entity. They may offer assets, non-monetary assets, to an entity. Example of these could be land or buildings or machinery. Or they could elect to reduce the liability of an entity, meaning the entity could owe government a certain amount, and government indicates that they will waive this loan or a portion thereof if certain conditions are met. It's important to note at this point that the manner in which the grant is received does not impact the accounting treatment. Therefore, the recognition and measurement which we will discuss going forward is not affected by whether the assets have been received in cash, in the form of non-monetary assets, with the reduction of the liability. In order for an asset or for a government grant to be recognized, two conditions must be met. This is an AND test, not an OR test, which means that both conditions must be met before a grant can be recognized, before a government grant can be recognized. These conditions are that reasonable assurance must exist that the entity will comply with the conditions which are attached to the grant, and reasonable assurance must exist that the grant will be received. IAS 20 does not define the term reasonable assurance. Therefore, management will have to exercise their own judgment to determine whether or not the required level of assurance has been received. To the extent that this judgment is deemed to be a significant judgment, it should be disclosed in the financial statements, the considerations made by management, as well as the conclusion reached, to ensure that users are able to follow the decisions and conclusions made by management. Another thing to note would be that it is possible for an entity to receive a grant prior to meeting the conditions of the grant. Therefore, mere receipt does not guarantee that the conditions have already been met, and therefore does not immediately on its own indicate that the government grant should be recognized. If a grant is received, or when a grant is received, management should still perform the assessment to determine whether or not they believe that they have reasonable assurance that the entity will be able to comply with the conditions which are attached to the grant prior to the recognition thereof. The general principle that is applied when it comes to government grants or the recognition of government grants is that these are recognized in the profit or loss on a systematic basis over the periods in which the entity recognizes the related costs for which the grants are intended to compensate. This could result in a situation where the grants are deferred, or it could result in the grants being recognized in profit or loss immediately. Let me give you an example. If the grant is provided to allow the entity to purchase a depreciable asset, such as a building, the related government grant will only be recognized in profit or loss on a systematic basis in the same period as the depreciation on that asset. If, on the other hand, the government grant was provided to the entity to provide immediate financial support, or to compensate the entity for amounts which were expensed in prior periods, these government grants could be recognized in profit or loss immediately when they are received or when they become receivable. So government grants could be, as we mentioned earlier, government grants could be received in various forms. They could be received in cash, they could be received through non-monetary assets, they could be received through the reduction of a loan. For those government grants which are received in the form of a non-monetary asset, an entity has a choice on how to measure these. These could be measured either at fair value or at nominal value. So if the government provides an entity with land which is valued at 1 million rand at the date that the grant should be recognized, the entity could elect to recognize that land at 1 million rand along with the related government grant. However, the entity is not required to use that method of measurement. A nominal value could be used instead. Although it may seem strange that there is a choice between these two particular methods, the standard does not specifically prescribe that one of these methods should be used in preference to the other. Therefore, the entity may choose which method works best for their particular set of circumstances. Of course, the policy selected should be disclosed in the financial statements to ensure that users are able to follow and understand the decisions which management has made. Another example of a government grant could be an interest-free loan or a loan provided at below market interest rates. These loans are within the scope of IFRS 9, so they will be measured in accordance with that standard. This means that on day one, the loans should be measured at fair value. Given the 0% interest rate or the interest rate below market, the fair value on day one will differ from the proceeds which the entity receives from the government. This difference is a government grant, and this should be recognized in accordance with IAS 20. If we look at an example, just to illustrate how this would play out in practice, we have Farmer Brown, who has now received an interest-free 5-year loan from government to an amount of 100,000 Rand. The fair value on day one is calculated at 80,000 Rand. The discounting is done using a market-related interest rate. So when we have to process the accounting entries in the books of Farmer Brown, we would debit the cash with 100,000 Rand, which is actually what received by Farmer Brown. We will debit the loan with 80,000 Rand, which is the fair value on day one in accordance with IFRS 9. And the difference of 20,000 will then be the government grant, which will be accounted for in accordance with IAS 20. The accounting for the portion which is in the scope of IAS 20 will depend on the terms related to this grant, as well as the purpose for which the loan was received. If, for instance, the loan was received to subsidize training costs over a 3-year period, it may be then appropriate to straight line the loan over the 3-year period. On the other hand, if it was provided so as to ensure that the entity has immediate financial support, it may be more appropriate to recognize this entire amount immediately in profit or loss. And if the loan was provided to the entities or to Farmer Brown to enable the farmer to finance the purchase of a depreciable asset, the government grant will be recognized in profit or loss on the same basis as the depreciation of the asset. So you see that the principles of IAS 20 do not change. The government grant will still be recognized in profit or loss on a systematic basis over the periods in which the expenses for the related costs which the grant is meant to compensate are recognized. So now, when we look at the presentation of government grants, we should note that there's different presentation applied to different types of grants. So we could have government grants which are related to assets, or we could have those grants which are related to income. The grants which are related to assets are those for which a primary condition for an entity to obtain this grant is that the entity is required to purchase, construct, or otherwise obtain long-term assets. Another condition may be attached, which will then restrict the type of asset to be acquired, the location where this asset must be used, or perhaps even the periods during which the assets are to be acquired and held. Other grants which do not meet these conditions are then referred to as grants related to income. So the grants which are related to assets, 2 methods exist for the presentation of these assets. On one hand, an entity may elect to recognize the government grant separate from the asset. In this instance, if an entity has an asset of 1 million Rand and they obtain a government grant of 250,000 Rand, they would recognize PPE of 1 million and recognize deferred income of 250,000 Rand. The government grant would then be released to the income statement as the underlying asset or the related asset is depreciated. Under option 2, the entity may elect to offset the value of the grant against the carrying amount of the asset. So instead of recognizing them separately on the statement of financial position, they would then, or present them separately on the statement of financial position, they would then be presented as one amount. This would be the million less than 250,000, so we'd have an initial carrying value of 750,000 Rand. When we look at grants related to income, 2 methods again exist for how these could be presented on the statement of comprehensive income. An entity may elect to present government grants as a separate line item under income or under other income, but separate from the expenses to which they relate. The supporters of this view believe that it is not correct to offset income and expenses, therefore think this is the preferable method. The other option is to recognize the government grant as an offset to the expense to which it relates, thereby reducing the said expense. The supporters of this view believe that this is the appropriate method to recognize because the underlying expense may very well not have been incurred had the grant not been made available to the entity in the first place. Both methods are acceptable in terms of the standard. The entity should just clarify which method they've selected and ensure that presentation is clear for users to understand which amount relates to the government grant versus which amount relates to the expense. Another thing to note on the grants which relates to assets. Although presentation of the statement of financial position can be done separately or on a net basis, when we now look at the statement of financial position, it is important to ensure that these amounts are recognized separately on a gross basis, as these could be significant cash flows for an entity. So the gross cash receipts from the government grant should be recognized separately from the gross cash payments on the purchase of the asset. So another question arises: what is supposed to happen if the government grant needs to be repaid in subsequent periods? These grants will be recognized as a change in accounting estimate in accordance with IAS 8. Therefore, will be recognized prospectively. So let's look at an example just to clarify how this would work in practice. If we have Farmer Brown yet again, who purchases equipment with 100,000 Rand in the 20x1 financial period. In this period, Farmer Brown receives a cash grant to the value of 25,000 Rand. All conditions required to recognize the grant were met at this date. However, during the 20x3 financial period, it is determined that Farmer Brown is required to repay this loan. We will now look at how this should be accounted for using both methods for the presentation of assets. Under Method A, the grant is shown as deferred income, separate from the underlying asset. So in 20x1, the entity would have recognized deferred income of 25,000 Rand. It is determined at this date that the asset has a useful life of 5 years and a residual value of 0, and will be depreciated using the straight line method. This means that an amount of 5,000 Rand will be recognized in profit or loss every year for the 5-year useful life, unless of course there is a change in estimate in either the depreciation rate, the residual value, or the method on which that is used to depreciate. However, assuming that nothing has changed, when we get to the end of 20x3 before the repayment, deferred income to the amount of 15,000 Rand has already been released to profit and loss. This means that the remaining balance in the deferred income account is 10,000 Rand. The repayment, required, however, is of the full 25,000 Rand. What needs to happen in this instance is that if the amount in the deferred income balance was equal to or more than the 35,000 Rand, we would reduce the deferred income balance with the repayment. However, as it is less than, we will reduce the deferred income balance to an amount of 0, and the excess will then be recognized in profit or loss in that period. You see in this instance that the asset has not been affected directly by any of these changes. Under Method B, this is now the method where the grant was deducted directly against the cost of the underlying asset. On day 1 in 20x1, the original cost of the equipment was 100,000 Rand. This was then reduced by the 25,000 Rand government grant, which brought us to a value of 75,000 Rand for the asset. Same facts as in Method A, the useful life is 5 years. This will be depreciated using the straight line method, and the asset has a residual value of 0. The depreciation expense, which will be recognized on an annual basis, will be 15,000 Rand. So when we reach the end of 20x3, we've recognized 3 as a depreciation, therefore 45,000 Rand. The remaining balance of the asset, the carrying amount of the asset at that date, is 30,000 Rand. However, now the grant of 25,000 needs to be repaid. And what happens in this instance is this amount is added back to the asset, thereby increasing the balance of the asset. So the new balance is now 55,000 Rand. In addition to this, the additional depreciation which would have been recognized in prior periods had this grant not been deducted from the cost of the asset needs to be recognized in the current period in profit or loss. This amount is an amount of 5,000 Rand times the 3 years, therefore 15,000 Rand. So the carrying amount of the equipment at the end of 20x3 after the repayment of the grant then comes down to 40,000. 55,000 minus 15,000 brings us to a carrying amount of 40,000 Rand. If we now look at what is required to be disclosed in terms of IAS 20, these disclosure requirements are not extensive. The entities are simply required to disclose the accounting policy which has been adopted, as well as the nature and extent of the government grants and other government assistance which has been obtained from the government. This would include assistance which may not necessarily have met the definition of a government grant and therefore has not been recognized in terms of IAS 20. In addition, any unfulfilled conditions which exist at year end should also be disclosed. That brings us to the end of the discussion on IAS 20. We are now looking at IFRIC 12 on service concession arrangements. The objective of this interpretation was to establish the general principles on recognizing and measuring obligations as well as the related rights in public to private service concession arrangements. Just to provide some background, typically in most jurisdictions, the public sector is responsible for the provision of roads, bridges, hospitals, etc. However, in some jurisdictions, the government encourages the private sector to get involved in the construction, operation, maintenance, and management of certain of these infrastructure assets. These arrangements are governed through contractual arrangements, which provides a basis for the set of the performance standards which entities must meet, the mechanisms for the adjustment of prices, as well as for arbitrating any disputes between the government, the public sector entity, and the private sector entity. These arrangements involve a sector entity, which is referred to as an operator, and a government entity, which is referred to as a grantor. A key feature is that is a public service in nature of the service which is provided. So you'll often find that there's a public policy which states that the services related to this infrastructure assets should be provided to the public, irrespective of the identity of the party which operates the service. So common features which you find in these types of arrangements is that there's a government or other public sector entity which grants a service arrangement to a private sector body. So the government could be a national body, a local body, or a government entity. This operator is then responsible for at least some of the management of the infrastructure as well as the related services. They do not act as an agent because this management is their responsibility. The contract between the operator and the grantor sets the prices and regulates price revisions over the contract period. And the operator is obliged to hand infrastructure over to the government entity in a specified condition at the end of the period. For this handover, the government entity or the public sector entity is required to pay little or no incremental consideration, irrespective of which party financed the initial construction or acquisition of these infrastructure assets. From the onset, I think we should clarify that IFRIC 12 governs only the accounting for the operator. The accounting for the grantor is not included in this interpretation. For an arrangement to fall within the scope of IFRIC 12, it must meet two criteria. One, the grantor must control and regulate the services which the operator must provide using the infrastructure assets. It must regulate who the service is provided to, as well as at which price the operator can provide these services. So to specifically look at the price, this price may be a fixed amount which is determined in the contract, or it could be an amount which is determinable. However, the conditions in the contract should be assessed to determine whether or not these are substantive. For example, the contract could state that a price cap exists. However, upon further inspection, the conditions under which this cap exists would likely only occur in remote circumstances. This would render the provision not to be a substantive provision and would not be considered then in our control assessment. Similarly, the contract may state that the operator has control of the price. However, it also states that any profits which the operator obtains in excess of a certain amount need to be returned to the grantor. This clearly indicates that the income which the operator can make from this deal, from this management service, are restricted and they're fixed by the grantor. So the considerations or the terms of the contract should be assessed carefully to ensure that a correct assessment is made. It could also occur that certain assets which could be separated physically and could be operated separately and would meet the definition of a cash generating unit in terms of IAS 36 could be subject to different assessments. An example of these kind of assets could be a private wing in a public hospital. So it may very well be that the public sector entity, the grantor, does not have control and does not regulate the operations which occur in the private wing. However, the remainder of the hospital is governed in accordance with the terms of the service arrangement, and these are regulated by the grantor. The second condition which must be met is that the grantor must receive any significant residual interest in the infrastructure at the end of the contract period. The residual interest is determined as the current value or the estimated current value of infrastructure if it were already at the end of its useful life. So basically, what would the value of this asset be currently if it were already at the age and condition which you expect it to be at the end of the contract period? If, however, the entities expect that this asset will be used throughout its useful life, and therefore there will not be a significant residual value or significant residual interest at the end of the contract period, this criteria can be ignored and the assessment can be based solely on whether or not the grantor controls the services, the recipients, and the price in terms of the service concession arrangement. IFRIC 12 applies to infrastructure which the operator constructs, as well as the infrastructure which an operator may acquire from a third party. It also applies to existing infrastructure which the grantor gives the operator to access to just for the purposes of this arrangement. Any assets which are owned by the operator are not the subject of this interpretation. A simple decision tree has been provided to make this assessment a bit easier. So our starting points would be to assess whether the grantor regulates the services, the people to whom the services could be provided to, as well as the price at which these services are provided. If we answer no to this question, we are immediately outside the scope of IFRIC 12 and must look somewhere else within IFRS for guidance. If you answer yes, we then further have to consider whether the grantor receives any significant residual from this asset. If no, we are outside the scope of IFRIC 12. However, if we answer yes, we have to consider whether the assets are constructed or acquired by the operator specifically for this project, and whether the assets will be fully used over the life of the contract. If yes, we're definitely within the scope of IFRIC 12. If no, another consideration should be made. Are these assets already existing assets of the grantor, which have been given to the operator solely for the purpose of this arrangement? If yes, we are still within the scope of IFRIC 12. So IFRIC 12 provides details of consensus which was reached on a number of issues which are of interest to users. One of these, we'll discuss all of these as we in the following slides. One would be how the operator should treat their rights over the infrastructure. Basically, should their rights, does this arrangement give them the right to recognize these infrastructure assets as PPE? Based on one of the requirements which an entity needs to meet to be within the scope of IFRIC 12, which an arrangement needs to meet to be within the scope of IFRIC 12, that the entity, that the control of the arrangement must lie with the grantor. It is quite clear that a key feature of the definition of an asset is not met. Therefore, these should not be recognized as PPE of the operator. The sales concession arrangement does not convey the right to control the use of the assets to the operator. The operator simply has access to operate the infrastructure assets and to provide public services on behalf of the grantor as per the agreement. A second issue which arose is the recognition and measurement requirements for the revenue received in this arrangement. In this arrangement, I think it is quite clear that the operator acts as a service provider. Therefore, the consideration which they receive as a result of this should be recognized in accordance with IFRS 15, revenue from contracts with customers. The nature of the consideration received will determine the subsequent accounting requirements. Another area which required consensus was on the correct accounting for the consideration received on the construction or upgrading services. The consensus was that IFRS 15 should be applied to these transactions. The consideration received can either take the form of a financial asset or an intangible asset. The consideration is determined to be a financial asset if it provides the operator with an unconditional right to receive cash or another financial asset from the grantor. In these instances, the grantor would have little or no discretion to avoid making the payment, as these arrangements are typically enforceable by law. An arrangement which would likely result in a financial asset would specify the amount of revenue or the price payable by the grantor to the operator, or this price could be determined by a certain formula included in the agreement. It could also happen that the contract simply states that the grantor will pay the operator any shortfall between the actual amount received from the users and a specified or determinable amount. Even if a certain condition exists that this payment will only occur if the operator is able to maintain a certain level of quality or efficiency, this payment can still be seen to be unconditional if the conditions discussed previously are met. If, however, the consideration is not received in the form of a financial asset, it could be received in the form of an intangible asset. In these instances, the operator is actually basically given a license to charge users for a public service. The operator does not have a right to claim any amount of cash or a fixed amount of cash from the grantor. The amount of cash which will eventually be received by the operator is determined on how the public uses the service. Therefore, it may occur, although unlikely, that if the public does not use the service, the operator will not receive any payment. If the payment is partly made up of a financial asset and partly of an intangible asset, the operator is required to account for the components separately. Consensus was also required to determine how operation services should be accounted for. These should also be accounted for in accordance with IFRS 15, revenue from contracts with customers. If the arrangement states that the operator is required to maintain the asset in a certain condition or restored to a specified condition before handing it over to the grantor at the end of the contract period, the operator should raise a provision under IAS 37. This provision should be measured at the entity's best estimate of the expenditure that will be required to settle the present obligation at the balance sheet date. Another area which required clarification was the correct treatment of borrowing costs. It was determined that the ruling standard on borrowing costs, being IAS 23, should be applied to determine the correct accounting for these borrowing costs. In summary, borrowing costs should be expensed unless they relate to a qualifying asset in terms of IAS 23. This could only occur if the entity obtains an intangible asset. In this instance, if this intangible asset is a qualifying asset as per IAS 23, then the borrowing cost should be capitalized to the asset. The last area on which consensus was obtained is on the correct treatment for assets received from the grantor. We had earlier in the webinars discussed how assets which the operator receives for the sole purpose of performing the service arrangement are not the PP of the entity. We already dealt with how those should be accounted for. So this is not what we are speaking about at this moment. We are now looking at assets which the entity has received for their own benefits, the operator has received for their own benefits, for which they can do it as they please, and for which the operator is not required to return to the grantor at the end of the service period. These assets should be accounted for as part of the transaction price under IFRS 15. These are not government grants as per IAS 20. They're actually part of the transaction price and within the scope of IFRS 15. A decision tree has been provided to assist entities to determine what type of consideration they've received and therefore determine the correct accounting, subsequent accounting for this. So our first step is to determine whether or not the operator has a contractual right to receive cash or another financial asset. If the answer to this is yes, the operator should recognize a financial asset in accordance with IFRS 9. IFRS 9 contains requirements which specify the subsequent treatment of financial assets, being whether these assets will subsequently be recognized at amortized cost, fair value through profit or loss, or fair value through other comprehensive income. If, however, our answer to this question was no, we then move on to the second question, where we assess whether the operator has a contractual right to charge users for the public service which they provide. If the answer is still no, we are unfortunately outside the scope of IFRIC 12, and guidance on the correct accounting treatment should then be sought from other standards within IFRS. If no guidance can be obtained, we are then in the scope of IAS 8, and entities will be required to draft their own accounting policies in accordance with IAS 8. If, however, the answer to the last question was yes, the entity should recognize an intangible asset under IAS 38, meaning that subsequent measurement will be in accordance with IAS 38. This brings us to the end of our webinar. Thank you for joining us, and we hope you've enjoyed this session. We are now available to take any questions. Thank you very much and have a great day further.